I think the 2-year roughly represents, with a lag, where the Fed can get to. So that's kind of how I'm using it as a base case.
Yeah.
We can also look at how much the Fed can push after the yield curve is already inverted, which is generally would be a somewhat lower ceiling because it's already inverted. So on one hand, the more dovish case is kind of the Luke Groman thesis that that they're really not going to get much further than they're already at, if at all. And some of the more I would think that's a possibility, but it's my expectation would be a little bit more hawkish than that. But then there's the very hawkish view of people that think that they actually can normalize this whole thing and then get to a period of positive real rates and they'll get inflation down. And so I disagree with that view. So my general expectation, unless I start to see signs of the opposite, is that they hike into Q4, potentially at a lower pace than they have been. Get around to where the 2-year got, and then they probably run into more acute issues if they try to go much further than that. If Powell truly thinks he's Volcker and tries to really, really press it, I mean, they could, might be able to get a little higher than that, but then I think you'd have such dysfunction and such liquidity issues that you probably would, they'd probably have to step in and reliquify the treasury market or something like that would be materializing. Basically, the various market forces are essentially trying to tell the Fed what to do. I think it's like clockwork. Every time the yield curve inverts, there's always a bunch of people that say, well, this time's different. It's not saying what it normally says. And it always takes some finesse, because if you look at global markets, the yield curve's not as predictive of their recessions than it is in the U.S. It's really, it's especially a U.S. phenomenon. But there's some signal elsewhere, but it's the highly predictive version of it is in U.S. markets. And there are a handful of different yield curves to look at. And so you can look at, a handful of them together to get the strongest signal. But I think that it came down to the common thing. I mean, people didn't want to think that a recession could be coming, and that it could be inverting so quickly after it inverted last time. I mean, it's not, it's not been a very long period since the pre-COVID inversion. And so I think that a lot of people were kind of in disbelief that the signal could be telling what it's always telling, which is either recession or at least significant economic weakness. The original studies, I think, were on the 10-year and 3-month. That's in some ways the most predictive one. The 10-2 is also quite predictive. There are a couple kind of like near misses there. There are a couple like periods where it got kind of squirrely. But essentially the 10-year 3-month is a slightly lagged version, which is basically just affirming the fact that the Fed's always going to hike on a lag. So the 2 years predicting what the Fed's going to do, and then the 3-month is kind of more representing what the Fed's actually doing.
Yeah.
Which is, a little bit on a lag with that. And so I think the 10-3 is a little bit more predictive of timing, but this whole period was condensed, right? So we had the biggest ever liquidity injection, or at least the biggest in modern history, and then the biggest kind of like pivot in terms of like trying to claw liquidity back out of the system that we've seen in a long time. And so it's perhaps not surprising that signals that might have normally been leading are instead coincident, because if it's compressed enough, that can be a pretty challenging environment. Another thing that the reason I was taking the yield curve seriously is that if you looked at the copper to gold ratio, that was saying the same thing. I mean, copper was like, generally in rising PMI environments, you'll have copper outperforming gold. And then in falling PMI environments, you'll have copper underperforming gold. And that's just pretty much like clockwork. And we're seeing PMIs are rolling over. Copper to gold is rolling over. Yield curve was flattening and eventually inverting. I mean, it was like this. It's like there's only so many things you can see happen until you have to conclude, either recession or at least, recession-like conditions. I mean, severe economic slowdown. In general, if you could buy from people that are forced liquidators, that tends to be a decent position to be in, right? So if you're buying like oil, when oil went negative, and if you're buying Bitcoin, I think from whales that are like, got over their skis with, using Bitcoin as collateral and then buying altcoins on leverage with it. I'm always happy to be a buyer of people that are getting liquidated. When something stops going down despite bad news continuing, that's generally a good sign for a reversal. Like, you've already priced in pretty catastrophic news.
Yeah.
If you look at various just say on-chain indicators or other things like that for Bitcoin, it's in one of those like firm value zones where it's below its on-chain cost basis. So people bought Bitcoin and they took it out, put it on their hardware wallet, and those prices. I mean, if you can run analytics on the blockchain and determine what is the average price that each Bitcoin last moved, each fractional Bitcoin, each UTXO. And when you aggregate those together, you get what is essentially an average on-chain cost basis. And historically, when Bitcoin goes slightly below the average on-chain cost basis, that generally starts marking, if not the bottom, at least kind of a deep value range that is, generally been, looking back 3 years in the future, a really good buying opportunity. And so, but it's always a thing. I mean, it's like, the future is never, just because something in the past happened, 3, 4, 5 times doesn't necessarily mean that the future has to play out like that. And so I've been looking at, just strength of the network, development on the Lightning Network, kind of the some of the startup capital going into that space. The maker of it was CoinKite. They make one of the hardware wallets. They were saying that they had a spike in sales during that liquidation, which is not something they normally see. So there's kind of a lot of buyers getting into some of the Bitcoin self-custodial hardware. I think there was an urge of people wanting to take their coins off of some of those lenders. I'm pretty optimistic long term on the health of the network. Generally, it does pretty poorly in falling PMI environments, pretty strong in positive PMI environments. But one thing we've generally noticed also in history is that Bitcoin usually bottoms before PMI bottoms. And I think that's in large part because liquidity tends to bottom before PMI bottoms. And so we've kind of washed out a lot of the hidden leverage. Some of it I saw coming, like the whole Luna fiasco. I wrote extensively about that, and even talked about that they might have to sell their Bitcoin into a weak market that could mark a major capitulation. So that kind of played out exactly as feared. Whereas the Three Arrows Capital liquidation, kind of the second leg, I mean, they were actually crippled by the whole Luna thing, but the whole second shoe to drop was that Three Arrows Capital, and then the whole kind of a cross lending environment.
Right.
So we got like that 1-2 punch that really kind of started with the Luna fiasco. But I'm more optimistic on the network now than I was, 6 months ago. It's something I've been, in my research reports, I've been saying, okay, I'm bullish on Bitcoin long term, but falling PMI environment, it really could be either way here. And I started writing about Luna. But now that we've kind of had some of these capitulations, I do like it here pretty long term. I think the best Bitcoin is self-custodial Bitcoin. But there are pools of capital that, let's say they want to slice in their IRA or something. They want some sort of paper representation of Bitcoin's price within their diversified pie of assets. And GBTC is still one of the ways to do it. It's partial play on Bitcoin price itself, and then it's also partial play on what is the probability in the next, say, 3 years that a spot ETF gets allowed, right? So Canada has one, some other countries have one. The United States is so far not allowed one. And so if GBTC could ever convert to an ETF, they could, that difference could be arbitraged quite quickly. I mean, ETFs, that's how they're different than those closed-end fund type of holdings. And so you basically have the combination of Bitcoin price action and then potential for closing of that gap. But of course, you also have risk of, if it goes 30%, there's nothing preventing it necessarily from going to like 40% discount to NAV if things get worse. So there is downside risk, but I do think GBTC is a reasonable paper representation of Bitcoin if someone does have that long-term view. But of course, they have all that counterparty risk and things like that.